Hi, my name is Sandra Bailey. I am the owner and founder of Women Financial Power, LLC. I am also a business partner with Executive Strategies Group, LLC. Today, we're going to be talking about annuities. Yay! I know a lot of you think annuities is a bad word because of some of the things you heard or read about it. And as we know, we can research Google and find good things and bad things about everything. But I own annuities and I also offer annuities. So I would like for you to sit back and enjoy the presentation. It will be two parts. The first part is going to be about 5 minutes. It's just going to be explaining the basics of annuities. The second part is going to dig a little deeper, and it'll probably be about maybe 20 minutes. So I think the whole presentation may be a total of 30 minutes. So let's sit back and enjoy. Hope you learned something. So let me start my screen share. Okay, here we go. So everything you need to know about annuities, but maybe you were confused or you didn't know what to ask because you don't like them, or you heard you don't like them, or you don't like that word annuities. They should have named it something else like guaranteed income or whatever, but people say, I just don't like that word annuities. Well, we're going to dig a little deeper into annuities right now. So before we get started, we're going to talk about what we like to accomplish when we talk to a client. And there's three main goals. The first is a retirement income plan to replace your income that you earn today. When you retire, you want that income. A long-term care protection plan, because the reality is that 70% of all individuals that reach age 65 or older will need some form of long-term care. I'm not trying to be all, down, Debbie down right now, but 80% of those are going to be women. And if you're like me, you probably know someone who needs long-term care, or you may be a caregiver yourself. So it's a reality here. And then finally, a legacy plan to maximize the income from your 401k savings or other savings, and to leave a legacy to your loved ones in charity, because you really don't want the majority of your money going to the Internal Revenue Service. So that's our goals when we have for each client. So let's get started. Okay, here's everything you need to know about annuities. There are only two types of annuities. There is immediate annuities and there is deferred annuities. Now, immediate annuities are the ones that get all the flack that people don't like, because immediate annuities is because you want it right now. You cannot wait. You give your money to the company and you want to start getting income right now. But if you do that, you may have heard of this term called annuitize. So annuitize means you give up control of your money, and you just don't want to do that. I mean, you don't want to just put it right then immediately and start income and annuitize it, because now you're no longer in control of your money. And that's the bad press that people get. They think if they put their money in an annuity and they die before all the money is used up, they can't leave it to their beneficiaries. And that is totally wrong, because you don't want the immediate annuity. What you want is a deferred annuity, and that's what we like. Yay! I need some pom-poms. Yay! We want a deferred annuity. So a deferred annuity is everything else besides an immediate annuity. Okay? So you don't want an immediate annuity to get it now. You want to get it later. You put your money in and you wait till later to get it. Deferred. Those are the only two types of annuities there is. Now, let's look at deferred annuities. So there's two types of deferred annuities. One is a variable annuity that's in the stock market, right? The other deferred annuity is a fixed annuity. That means it's not in the stock market, okay? Now there's two kinds of fixed annuities. There is a multi-year guaranteed annuity, and there's an indexed annuity. So a multi-year guarantee annuity, you can compare it to a bank CD, because they range from 2 years to 5 years, like a bank CD, okay? And then an index is based on the movement of the stock market. They're indices. And so an index may be the S&P 500. A lot of people know about that. So basically, that's it. Those are the three categories of an annuity. So most people like annuities because they're safe. So there are only 4 places that are safe that you can put your money. So let's think about the first place is in the cookie jar, right? You can put your money in the cookie jar, under the mattress, buried in your backyard. That's cash. It's not going to grow, but it's normally going to be safe unless your house burned down or dog, digs up the money and somebody comes and steal it. But mostly that's safe. Second place you can put your money is in the bank. You can put your money in the bank and it's safe. Nothing's going to happen to it. It's going to be safe, right? Or you can buy government instruments like treasury bills and bonds, and that's safe. The last place that you can put your money, y'all know where I'm going with this, is an insurance company. All right. Insurance companies are safe. They offer guarantees. And you guys, if you know me, y'all know I'm biased because I've worked in the insurance industry since 1980. I know I don't look like it, but I've worked in the insurance industry since 1980. So we're going to take a pause right there. Let's see now. How do I take a pause? Well, I can't figure out how to take a pause. But those are the basics that you need to know about annuities. Now, the next part of this presentation, we're going to dig a little deeper into annuities and what they can do for people who want safe money. All right, so let's get started on that. So we talked about the fixed annuity. That's the multi-year guarantee annuity. So the multi-year guarantee annuity, you can kind of compare that to a bank CD as we talked about. So let's look at the differences. With the bank CD, it's a short term, just like the multi-year guaranteed annuity. You're going to get from maybe 2 years to 5 years. With a MYGA, you can go 2 years, you can go up to 10 years. You can go longer, but I just don't recommend annuities longer than 10 years. The interest rate is taxed on a bank CD. So even though you don't get income from your bank CD, you will get a 1099 interest form at the end of the year. Now with the MYGA, your taxes are deferred until the money is withdrawn. So you're not going to get a 1099 until you get ready to start taking income out. So with a bank CD, your interest rate is generally lower. And that is proof in the pudding. You can go under bankrate.com. Let me see if I can show you that. September 3rd, I Googled bankrate.com and a 3-year CD rate was 0.85%. That was the maximum on a 3-year CD rate. Now with a multi-year guaranteed annuity, I ran the numbers for all of the different insurance carriers, and a 3-year MYGA rate was 2.35%. That's a huge difference, 0.85 versus 2.35. So that's a difference. Now we talk about, everybody says for banks are FDIC insured up to $250,000. Well, let's look at what does FDIC means. So FDIC is the Federal Deposit Insurance Corporation, okay? It's an independent agency created by Congress to maintain stability and public confidence in the nation's financial system. That's what it is. Federal Reserve dictates that banks must maintain 0 to 10% of their bank deposits in reserves. That's what the FDC is, all right? So let's look at the multi-year guaranteed annuity. The multi-year guaranteed annuity is based on the legal reserve system. They offer guarantees. And like I said, they fall under the state's legal reserve requirements. So legal reserve companies had their strongest year during the Great Depression. While banks had suspended their operations, and you guys may remember, even lately it happened years ago, where people couldn't get their money out of their bank account. Well, banks suspended their operations, but life insurance companies were not affected at all. And there's a lot of wealthy people that have their money in life insurance companies that were able to use their money to continue their businesses because a lot of people couldn't get money out of the banks. So insurance companies' reserve ranges from 8% to 12%. All right. Annuity companies hold dollar for dollar in reserve. So you're looking at 8% to 12% versus 0% to 10%. That's a big difference. Now, with a CD, a bank CD, probate is required to pass on to beneficiaries if you don't select it. So I want to tell everybody right now to be sure to go to your bank and add a beneficiary there. A lot of people just don't think about adding a beneficiary to their bank account, but you really should. Now, with the multi-year guaranteed annuity, your value of the annuity will avoid probate and it will pass directly to the beneficiary because, again, with that product, you cannot set it up without a beneficiary. But a lot of people just don't think about, I'm getting hot. A lot of people just don't think about adding a beneficiary to their bank account, but you really should. So let's look at a fixed index. Hot. So a fixed index works like this. You have 100,000 in the index. And if the market goes up, you make money. But if the market goes down, you stay flat. So when the market goes back up, you make money from where you were. If you were in the stock market, you still make money from there. But as you see, you have more money because you never had a loss. So that's how a fixed index works. When the market goes up, you make money. When it goes down, you just stay flat. So then I've had people ask, well, what kind of indexes can I participate in? Well, there's different crediting strategies. Almost all of the annuity companies will have the S&P index because everybody's familiar with the S&P. Then you may have the Barclays. This one has the Raven Pack. These are two different companies where you will see two different crediting methods that you can choose to invest in your money. This one has the Fidelity plan, lots of different companies. I won't go into detail, but I will talk about this briefly. You see the word cap. A lot of them may have a cap rate. So what a cap rate means is, say the market went up 10%, but your annuity had a 5% cap rate. So the market went up 10%, your cap is 5. So you would make 5%. PR is a participating rate. All right. A participating rate can be explained like, same example, the market went up 10%, but say your participation rate was 50%. So you would make 50% of what the market did. So you make 5. And then you will see, sometimes you'll see spread. Spread means the same example. Say the market went up 10% and you had a 3% spread. So a 3% spread means that you'll end up making 7%. So those are some of the terms that you will see in a fixed index annuity. So this is a brief example. I'm not going to spend a lot of time on it, but it just shows this was an annuity with a 55% participating rate. And this illustration showed when the market was down, both started at 100,000, but with an annuity, you would stay flat. With the actually being in the market, of course, you would lose money. So here, when the S&P was 26.4% growth, you only made 14.5% growth. That's an example of a participating rate. So now let's look at a fixed index example. So a fixed index example, and this is with every insurance company, you will get something called a guarantee. So the guarantee here, the insurance companies will go back 10 years and show you their highest, worst, and most current. So with the guarantee, they show you 0%. So basically a 0% guarantee is what you will get from the insurance company. And you would say 0%, that's nothing. That is a lot, people. 0% basically is saying that if the stock market returns 0 for 10 years and you in this annuity, or however many years you've been in this annuity, if the stock market returns 0%, they will guarantee you that you will never lose a penny of your money. That's the insurance company guarantee. And you tell me who else will offer you that type of guarantee. All right. So then they have a non-guaranteed. So the non-guarantee is based on the historical index period. This is a comparison for the most recent term, the lowest term, and the highest term that the insurance company actually paid out or returned in their policy. So with this particular company, it showed the most recent with the S&P, the Barclays, and the Ravens pack. Because in this particular annuity, you can choose how you want to diversify your money. So maybe they did 33 1/3 with each one of these indices. You have that option to do whatever you want to do. So during 2010 to 2020, the S&P showed the most recent, the lowest was 2010 and the highest was 2019. So if you look up here, it actually shows you what the indexes did, which is awesome. All right. So when you put it all together, the annual rate for the most recent term was 7.99. The lowest term, yes, I'm going too slow. The lowest term was 7.09 and the highest term was 9.56. Now, we know you don't get that all the time. You know, that's just not going to happen all the time. But this is what happened during this time frame. All right, during this particular time frame, the companies look back 60 years, 20 years, they show you 10 years of the highest, the lowest, and the most recent, because nobody knows what's going to happen in the future. So they show you what they've actually paid out in the past. And that is awesome. And matter of fact, I don't know if I have it anywhere on this slide, but I had clients who actually made 15.6%, 23% on their annuities. So that's just awesome. Now, this is the power of indexing. So basically, this is what we just talked about as a recap. The red line is the stock market, the S&P. The blue line is a multi-year guaranteed annuity or CD, just steady growth. And the green line is an index. So you will see when the market went down, the index stayed straight. You didn't lose anything. Now this is as of 2016, and I did see a slide that was as of 2019, and these numbers were almost neck and neck. They were really close together. So it just depends on, you know, what line you want for your retirement. That's all. So let's look at interest. We talked about interest rates. So the rule of 72 basically says you can divide your annual rate of return by 72, and that will tell you how many years it's going to take for you to double your money. All right. So if you had a 1% interest rate, which the bank CD was less than 1, it was a 0.85, but it would take 72 years to double your money. If you had an 8% interest rate divided by 72, it would take 9 years to double your money. And I always refer to Albert Einstein's quote. He says, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And that's a whole nother topic in itself. But just look at interest rates. Nobody can predict what's going to happen in the future, but you can kind of determine where you want some of your money, maybe not all of your money, but how you want to diversify and put money in different places. All right. And again, like I said, we don't know what will happen, but you know, last year people made money in the stock market and people made money in annuities as well. But I will say before I leave, the money that was made in the annuities, when the stock market does go back down, their money will be guaranteed. They will never lose those earnings. And that is a big difference. I just thought about it because if you're in the stock market, you can make money, then you drop it, you could lose money. In an annuity, when you make money, it's going to stay flat. If the market drops, you're never going to lose that money. So let's look at the 4% rule. So we all have heard about the 4% rule. Basically, the 4% rule says once you retire and you have this lump sum of money, say you have $1 million, the 4% rule says you can take 4% of that $1 million, which would be $40,000, and that is your withdrawal rate, the amount of money you might withdraw each year from the starting value of your portfolio and your bonds in retirement. So the experts consider a 4% rate to be safe, as withdrawals should consist of interest and dividends. If you research the 4% rule now, they tell you that with a tough market, you won't be able to withdraw 4%, because the statistics show that the 4% should last you 30 years. Again, I said should last you 30 years, but because of the volatility of the markets up and down, they say a year when the market is down, you shouldn't take the 4% out. You may need to take 2% out or 3% out. So then you have to just determine if that's what you want to do. Thinking about your money, thinking about not running out of money. It's just a lot to think about. So let's compare the 4% rule with a fixed indexed annuity. So let's look at this chart. And this came from one particular company. I don't have any special companies that I like, but I was working with this company and thought I'd put this out here. So let's look at a 4% withdrawal rate. You could be 55 years old and put your money into a fixed index annuity and get guaranteed a 4% withdrawal rate at 55 years old. Now, say you were a couple and you're married. Let's see how old you would be as a couple to get 4%. 65. At 65, you can do a joint of 4%. And what that means is you withdraw the 4%, you pass away, your spouse will continue drawing the 4% for the rest of their life. Now that is amazing. That's just like you can set up a pension that way. You can set up your annuity that way. All right. Now, the difference between the 4% rule and you managing your own money than allowing the insurance company to manage it is, what do we say again? You get guarantees. Now, look at this. The older you wait, deferred, the older you wait, the higher your percentages go up. So if you were single at 65, you could get 5% of your money guaranteed for your rest of your life. So guaranteed means guaranteed, right? So you could run out of the money you put in the annuity. And if you live a long life, way in your 90s, and a lot of people are living even to 100, you will be guaranteed to continue to receive that 5% until you die. Some of you may be older, say you're 70, you can get 5.5%. What we do, we look at the companies and find out which one has the highest rate based on your age. So these are just amazing. So to recap, if you're looking for safety, guarantees, competitive returns, this is where you want, right? Now I added bonuses because some annuities have bonuses. Some annuities, you put money in for the first 5 years. One in particular that's coming to mind, you get a 6% bonus for the first 5 years you put money into the annuity. Sometimes you may give up higher interest crediting rates to get a bonus. So it just depends on when you want your money. Now, the majority of the annuities have no fees, but again, there may be some annuities with fees, depending on what you want. We have to talk about those things. And then if you talk to me or any advisor, they should tell you which ones have fees and why their fees are out there. And then you see give up liquidity. What's that? Why do I have to give up liquidity? You give up liquidity for getting all of these extra things. Because if you have money in the market, you can get it out whenever you want to. There are some annuities that can do that as well. There are some annuities that have a return of premium rider. So it means if you put the money in there and you wait a year or two, then you may not even have a surrender penalty. So you say, Sandra, we haven't even talked about surrender penalties. So let me try to make this quick. Surrender penalty, if you get, say, a 10-year annuity, and then in 3 or 4 years, you want to take all the money out, then you may have a 9 or 8% surrender penalty. But if you don't want to take all the money out, you can get 10% free withdrawals every year. You can get 20% with some companies. But if you decide you don't want it anymore, and you want to take all of it out, there may be that surrender penalty. However, based on what you may want, there are some companies, like I said, that have a return of premium rider. And if you change your mind, you get all your money back with no penalty at all. So you have to talk to us and let us know what is important to you. What do you want to happen? And then that's how we go in and find the right product. And then lastly, I want to add, the Secure Act of 2019 gave employers greater flexibility to include annuities in their 401k plan. Because when you're working and you have a 401k plan, you're accumulating cash. So at the end, you don't know how much money you're going to get from that 401k. You don't know what your retirement's going to be from that 401k. You just have accumulation of cash. So now employers can add annuities in their 401k plan, which is awesome. So now I want to look at who uses annuities. And I really like this advice, this article from Think Advisor. It says, are you as dumb as Ben Bernanke? Now, you know, Ben Bernanke is the federal chief, right? And he handles money. So we all know you can Google anything. And there's a lot of articles about Ben Bernanke being so stupid for putting his money in annuities. So in annual reports from the central bank, the Fed chief and its governors must report their personal investments and holdings. And would you believe that Ben Bernanke's two largest personal investments are fixed and variable annuities? He has both of them. So a lot of people, of course, has been saying how stupid and how dumb can he be for putting his money there. But this writer must have seen a lot of the negative print. And he says, who is the wiser, the financial expert who writes about money, or the mover, shaker, and the policymaker? My money is on Ben Bernanke and other highly successful people who see the value of an institution, such as an insurance company, standing behind its investments and protecting their money from ultimate losses, whether living or dying. Who knows? Maybe Ben is dumb like a fox. I thought that was interesting because you're going to find negative information everywhere you go. But I thought this was a cool article. Now let's look way back during the Great Depression. So Babe Ruth used annuities. You know, Babe Ruth was working, making good money back in the day, and then the Great Depression hit. Well, before the Great Depression hit, his insurance agent introduced him to Equitable insurance company so he can invest some of his annuities in there. So he would put in more than half of his salary annually into purchasing annuities. So then during the Great Depression and he wasn't working, he was unemployed, then what did he do? He had income coming from his annuities to pay him. He liked him so well that he got one for his wife as well. So Babe Ruth says, I may take risk in life, but I will never risk my money. I use annuities and I never have to worry about my money. Now, I hope that's a true statement that we found on the internet. Because again, you can find some good stuff and some bad stuff. But Babe Ruth knew that his human capital had gone down and he couldn't play ball any longer. So, you know, during the Great Depression, Babe Ruth didn't lose any of his money due to annuities. That's awesome. Now, this is my all-time favorite story, and I'm gonna try to get through it quick because I didn't want this to go over 25 minutes, over 30 minutes. But what Bernie Madoff, baseball and annuities have in common is Bobby Bonelli Day. So my favorite story, even though I'm not a baseball fan, I only watched baseball when my grandfather was living. It was the most boringest thing ever. But this was such an interesting story because Bobby Bonelli, the article says that he was not a good player and the Mets wanted him out of there. They owed him almost $6 million for the rest of the season. But Bobby Bonelli was very smart. He said, I don't want to get the whole $6 million. I want guaranteed annual payments. And so he was going to get it until he was 72 years old, 25 years. So the Mets agreed to pay Bobby Bonelli almost $1.2 million every year until he was 72 years old, because the Mets were like, we'll pay him this deferred annuity payment at an 8% interest rate because guess what? We're investing with Bernie Madoff and we're going to make way more than 8%. So we all know what happened then, right? Because Bernie Madoff came to light in 2008. In 2009, Madoff pleaded guilty to using wealth management to cheat thousands of investors out of an estimated $20 billion in a massive Ponzi scheme. So that right there says it all. Crime doesn't pay, but successful contracts with annuities do. So a lot of people will say, well, if Bobby Nelly had taken the lump sum of $6 million in 2000 and invested in the S&P stock market, he would have about $9 million in 2015. But instead of investing it and getting the annuity payments, because again, annuities are a contract. And if you sign that contract, you have to pay what the contract says. So he will get almost $1.2 million for 25 years. That's over $30 million that he has turned his $6 million into $30 million. And that's just awesome. That's just awesome. So anyway, so now we're going to look at having a private IRA, an individual retirement account, or an individual retirement annuity. All right. This is what this presentation has been about, to explain annuities. And hopefully you guys got some information out of it and maybe learned some things you didn't know. But this is how wealthy people protect their wealth. Everybody we saw in these examples were wealthy. So you don't have to be wealthy to get one. You can do it as well. They provide coverage for the most common concerns in retirement. What are the common concerns in retirement? Outliving your money and rising health costs. And so those are concerns. So with annuities, you know they're guaranteed. You're going to get that money for the rest of your life. Once you get one of these, you're going to reduce your advisory fees because you no longer have to pay those fees with an annuity. All right. You pay 0 commissions because the insurance company pays us, independent agent. The company pays an advisory, a commission. So that's how we make money. But you don't pay any commissions. You pay nothing. Okay. The next thing I wanted to talk about, these can be designed for accumulation, just growth only, if you don't want to set it up for income, or you can design it to set it up to generate income for the rest of your life. It depends on what you want. So you can use the income to set up your own personal pension, or you can never outlive it. Now, main thing, when at the beginning, we talked about long-term care. So some of these annuities, which is really awesome, what I'll say, all of the annuities, say you needed assistance with your activities of daily living and you had an annuity. The annuities, you would never have a surrender charge for taking money out for that. All of the companies that I represent, you'll have a nursing home rider, or if you can't do 2 of 6 activities of daily living, you can take your money out with no penalty whatsoever. Now, on the other hand, say you set up an annuity that gave you income for life. There are certain annuities out there, if you set up income for life, they will double that income for up to 5 years if you need nursing home care. And then if you're still in nursing home or need assisted living, or you can't do 2 of 6 activities of daily living, some of them you don't have to be in a nursing home. You could be at home and can't do 2 of your 6 activities of daily living. They will double your monthly benefit that you're getting for life up to 5 years. And if you still need it over 5 years, you just go back to getting your regular income for the rest of your life. And then there's other companies that may not double it, but they may give you a higher percentage, like 10% more, up to 25% more. So that's just a cool thing to think about as well. Let's see here. My mouse, so I can turn the page. Stuck. Sorry. Come on, I can't turn the page. Oh, Lord, let me see if I can pack it. There you go with my finger. Okay, you can invest in an annuity, and your hard-earned money won't be invested in the market. I'm not sure what happened to my thing. Yeah, I'm sorry. And you won't be invested in the market. So we're not going to go over all of these, but we talked about it. We talked about the guarantees, the tax deferrals, the market upsides, the wealth transfer, just a lot of things. And that's the end of our presentation. So as you can see, this is the website. You can set an appointment with us by going to womenfinancialpower.com. The email address is sandrab@womenfinancialpower.com, or I have an executive at sandra@executivestrategiesllc.com. But then here are all of our social media handles. So join me, follow me. And if you have any questions, shoot me an email, or shoot me an email and I'll answer your individual questions for you. And so thank you so much for joining, and I appreciate you for sticking around. So hopefully I'll talk to you soon. Bye-bye.